How is everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. We're keeping the crypto series rolling along here this week. This is installment number 25 in the crypto series, and I have got a ton of crypto-related news for everybody. Obviously, on Friday last week, we had the passing of the Genius Act, along with two other crypto bills that came in, and we're gonna run through a series of articles here in this episode very quickly, just to give everybody a rundown on what's happening in the crypto world, because so much is happening, and it just every day it seems like there's more stuff going on. So like you said, on Friday, we were coming off what Congress had deemed a crypto week. We basically had three bills that got passed. The Genius Act was the first bill that got passed by the House. That was already passed by the Senate, so that went directly to President Trump's desk to be signed into law. But then we also had two other bills. We had the Clarity Act, which was H.R. 3633. That is the market structure bill that would determine which crypto assets and intermediaries are regulated by the Commodities Future Trading Commission or the Securities and Exchange Commission. The third bill was called the Anti-CBDC Surveillance State Act, also known as H.R. 1919, and that is an ICBA supported bill to bar the Federal Reserve from issuing a central bank digital currency to consumers. Now, that, interestingly enough, that bill passed almost on partisan vote. It was 219 to 210, so maybe one Democrat voted for it. But those two bills, the Clarity Act and the Anti-Central Bank Digital Currency Act, are both on their way to the Senate to be voted on there. We'll see what happens there. It's just kind of surprising that the Central Bank Digital Currency Act would be such a partisan vote. I would have thought that both, I would have just thought there would have been more people on both sides of the aisle that would have been like, yeah, that's fine. Like we don't want the Federal Reserve to issue a central bank digital currency, but apparently not. So we'll see how that one goes. We'll see how those two get into the Senate. But I would just like to say that I hope these three bills all get through, because you could think of these three bills like a three-legged stool. And we've got one leg of the stool through, and if the other two legs don't get passed and don't come through, you're going to end up with this really messed up regulation around, cryptocurrency. So again, I'm hoping that these other two bills get through and that we have this three-legged stool, if you will, in regulatory framework, because those three bills together really complete the regulatory framework around stablecoins and cryptocurrency that will enable them to have a lot of clarity and be able to, if you want to call it, taking it to the next level, however you want to phrase that. But they're all really, really important. So I just wanted to say that. The other thing here that is a major concern for banks is, they're cautious with this. Like obviously they perhaps see this as a great opportunity, and we're going to get into this in a minute with a few of the other articles that I'm going to run through here, as far as what's Jamie Dimon thinking, what are some of the other big banks thinking in regard to this. But their real concern: lawmakers must work to fully mitigate the risks to the economy that would result from the outflow of community bank deposits to payment stablecoins. So there is a fear. If you go back, and there was another episode I did, wasn't part of the crypto series, but there was an episode I did covering a Treasury report from a few months ago that basically they laid out a whole case for this, saying that, if stable coins grow to a $2 or $3 trillion market, that, banks could potentially lose 10 to 20% of their deposits because of this, and now they're both good and bad to that. The good side is that, maybe those stable coins are held at some of these banks. The bad side is that, obviously if banks are losing deposits, that could hurt credit, because that could diminish a bank's ability to lend, reducing the availability of credit in the market. So there are concerns there with some of this stuff. So we'll have to consider that. But Trump signs major crypto bill to set up stablecoin regulatory framework. This could be perhaps the greatest revolution of financial technology since the birth of the internet. Yes, I believe that is true. I don't think that is an understatement, but let's keep rolling here. So Jamie Dimon says JPMorgan Chase will get involved in stablecoins as fintech threat looms. So JPMorgan Chase CEO Jamie Dimon said he doesn't get the appeal of stablecoins, but he also can't afford to stay on the sidelines. Last month, JPMorgan announced it will launch a more limited version of a stablecoin that only works for JPMorgan clients. A true stablecoin would presumably be more universally accepted. We're going to be involved in both JPMorgan deposit coin and stablecoins to understand it, to be good at it, Diamond said. Citigroup and Bank of America executives have also said they would get involved. Now, that takes us to this from Banking Dive. Big bank CEOs talk stablecoin plans. The prospect of a more favorable regulatory environment for digital assets has large lenders exploring or plotting stablecoin plans. JPMorgan, Bank of America, Citibank, and U.S. Bank executives indicated this week. So amid Capitol Hill and corporate buzz around stablecoins, big bank CEOs this week conveyed they won't be left behind in the stablecoin space, although there's still plenty to figure out as it relates to the burgeoning cryptocurrency. After the Senate passed the Genius Act in June, the House this week has prepared for a vote on legislation that would regulate the stablecoin industry. That timing has executives at large banks reporting second quarter earnings this week, and those earnings were really good. This is from last week, facing questions about their organization's potential involvement in the stablecoin ecosystem, including whether a Zelle-style bank group may develop with interoperability in mind. Stablecoin refers to a type of cryptocurrency whose value is pegged to fiat currency such as the US dollar. JPMorgan Chase CEO Jamie Dimon on Tuesday said the biggest US bank will be involved in both JPMorgan deposit and stablecoins. Let's see here. What else are we saying here? I think they're real, but I don't know why you'd want a stablecoin as opposed to just a payment, Diamond mused. But given fintech's activity in the space, we have to be cognizant of that. And the way to be cognizant is to be involved. So we're going to be in it and learning a lot. So analysts on New York-based JPMorgan and Bank of America earnings calls asked about the potential for a bank consortium like Zelle, the peer-to-peer payment platform, to ward off the competitive threat from stablecoin companies like Circle, as the banks did to respond to PayPal's Venmo and Block's Cash App. Diamond said that raises a great point, and we'll leave it remaining as a question. You can assume we're thinking about all that, Diamond said. Bank of America CEO Brian Moynihan said Wednesday he expects to see such a network, as well as banks moving individually on the commercial side in particular. You need networks to make all this work, he said. It'll be a complex array and hopefully not complex for the consumer or customer. When it comes to stablecoins as a traditional device, Moynihan told analysts to expect the industry and the Charlotte, North Carolina-based company to be involved. We'll be there, just like we were when we were moved from checks to Zelle, he said. However, we're still trying to figure out how big or small it is, he said. Business cases are still to be proven, frankly. So very interesting. Now, I will put on a minor note, I am doing another episode on the Zelle payment network. Keep an eye out for that on Friday. That episode comes out where I look at another article and examine more in depth, why would community banks not necessarily want to use Zelle? It's cost prohibitive. There's some other issues, but so it's kind of interesting when they put out the network, because Zelle has not been is perhaps as great as what people thought. The other thing with the other problem with Zelle is fraud. Fraud is a major problem with the Zelle network. And Zelle is a distant third compared. Cash App and Venmo, they're the two big players, Zelle is there, but it's a distant third. So again, just on a side note. So, okay. Couple other articles here. So Ether takes spotlight as Trump signs stablecoin bill into first major U.S. crypto law. So Ether climbed to end the week as President Trump signed the Genius Act into law, while Bitcoin and its proxies took a breather. Crypto stocks were off their session highs as the broader market took to a lower leg after Trump reportedly pushed for greater tariffs on the European Union. Ether has advanced 18% this week, bringing its two-week gain to about 43%, its strongest two-week period since August of 2021. So, and then here was an interesting article. So I just did last week episode 426, which was basically asked the question, should people be investing in stock tokens? And then interestingly enough, a few days later, this article came out from the Wall Street Journal. Want to trade Amazon on crypto exchange? The price might be off by 300%. Digital tokens tracking popular stocks such as Apple deviate wildly from underlying prices and raise concerns about lack of regulatory oversight. So crypto firms are trying to use blockchain to reinvent the stock market, but tokenized stocks have had a rocky start. Tokens backing stocks like Apple and Amazon have seen wild price swings, and Robinhood faces scrutiny over its OpenAI token. Some worry tokenized stocks could enable insider trading and market manipulation due to a lack of regulatory oversight. So crypto companies have grand plans to reinvent the stock market using blockchain technology. They are off to a bumpy start. Digital tokens designed to track popular stocks such as Amazon and Apple have deviated wildly from the price of the underlying shares since their launch 2 weeks ago. Robinhood Markets is facing scrutiny from its European regulator after it launched a token designed to let investors bet on OpenAI without getting permission from the artificial intelligence startup. That's key. They did not get permission. And even some industry insiders fret that such tokenized stocks create opportunities for bad actors to engage in insider trading and market manipulation without getting caught. So in a flurry of announcements in late June, companies including Robinhood, Kraken, Gemini, and Bybit unveiled blockchain-based versions of U.S. stocks and exchange-traded funds for non-U.S. customers. Crypto executives hailed them as a way to let people worldwide invest in Tesla, NVIDIA, the Spider S&P 500 ETF, and other buzzy securities, especially in countries where it would be difficult to buy U.S. stocks through a local brokerage. By tokenizing equities, we believe we can export U.S. capital markets anywhere in the world. Yeah, but here's the problem. You're not getting permission from these companies to issue this token. And these tokens are not, they're not equity. They're not stock. They in no way represent ownership of any kind in this company. I mean, this is literally just like make-believe stock. Like, oh, hey, I'm going to, yeah, you know what? I'm going to take this book here and I'm going to issue a token on this book. You know, it's like, did I write this book? Am I the author? Am I the publisher? Do I have royalties to this book in any way, shape, or form? Like, no, I don't. But yet I'm going to sell you this stock token that's going to somehow represent the royalties to this book that I don't own, have no right to. So it just makes no sense. And it's just crazy that they would even be attempting to put this out there. But of course, you notice they're not doing this in the U.S. They're doing this in Europe, and they're doing this in other countries where they're hoping that they were hoping that this probably takes off, and it basically people see how wildly popular it is. Therefore, you know, companies in the U.S. will just be like, oh, well, you know, hey, it's popular. Hey, why don't we get in on the action, whatever. But yeah, I just think this is going to be a colossal disaster, because this is just to me, it's just fraud. It's just straight up fraud, but we'll see what happens there. And then finally, last article I have here for everybody today is crypto bad for the deficit, the hidden costs you could end up paying. Thought this was a very interesting article. So Bitcoin and other decentralized crypto assets could undermine government control over fiscal policy, making deficits harder to manage and tax revenue more difficult to collect. Stablecoins, especially dollar-backed ones, currently help support U.S. debt markets, but may weaken monetary sovereignty in other countries. So, and it goes into what crypto has to do with fiscal deficits. So monetary policy disruption, inflationary pressure without output, stablecoin support for U.S. dollar, so dollar-backed stablecoins, percent, and then it gets into a chart, percentage change in gross U.S. federal debt year over year. And then it goes into the hidden cost, you know, tax gaps, regulation, and environmental effects. And as another thing here, another chart, top crypto stablecoins by market share. Obviously, Tether with about 70% of the market. That's the big one. Yeah, and then can crypto actually help the deficit? So there are scenarios where crypto could be a fiscal asset. Countries could treat Bitcoin as a strategic digital reserve, with benefits accruing should its value increase. Stablecoins could run remittance costs and drive economic growth, boosting tax revenues. This gentleman, Ruddick, said that while some have pointed to cryptocurrency's stellar price appreciation track record and noted the potential for it to eventually help with the national debt, these benefits depend on how crypto is regulated and global cooperation to close tax gaps and manage risks. So what is the bottom line? So crypto's impacts on deficits isn't black and white. While Bitcoin and decentralized assets complicate fiscal policy and tax collection, the hidden cost, lost tax revenue, signiorage, and regulatory burdens are real. Nevertheless, stablecoins could help support U.S. debt markets, although they currently represent only a tiny percentage of the treasury market. So again, very interesting, very interesting article indeed. Could cryptocurrencies basically mess with the federal deficit? Could it make it hard for us to collect taxes? These are some very interesting questions here. We'll have to see how some of this plays out indeed. But again, a lot of information, a lot going on in the crypto world. I hope that you guys are enjoying these crypto episodes, providing these crypto updates of all things happening in the crypto world right now. So I will wrap it up by saying, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. Thank you for listening, and I will see everyone again real soon.